Good evening. Thank you for joining us. Welcome to the Startup Path webinar series on the basics of starting your own business. We are delighted to offer these free webinars because we believe that entrepreneurs are the drivers of wealth creation around the world. My name is Sheena Pasco. I'm the Director of Marketing for the Startup Path. Before I introduce our guest speaker, I want to tell you about the resources we have created for you at the Startup Path. Step 1 features our free webinar series where you will learn the basics of starting your own business. Step 2 provides you with assessment tools to help you find the right fit between who you are and the wide variety of business opportunities that exist. Finding the right fit between your personality and the type of business you start is crucial to your success. Step 3 enables you to learn a business from a mentor. We currently have 24 mentors online who reveal their tips, techniques, and secrets to success in a wide range of industries. We have packaged each mentor's journey and advice into a talk show format that we call the Startup Experience. Steps 4 through 6 contain 21 online lessons that cover everything you need to know about starting, growing, and running your own business. The featured speaker in today's webinar is the Startup Path's resident expert in entrepreneurship, Dr. Tom Duening. Dr. Duening is the director of the Center for Entrepreneurship at the University of Colorado in Colorado Springs. He has been an entrepreneur since 1984 and has started and ran 7 businesses in his career. Dr. Duening has also written 12 books on business and entrepreneurship and has consulted with startups in a wide range of industries. Please be aware you may see the waiting room screen come up again as we transition into Tom's presentation. Today he will be giving insight on how to access capital. It is my pleasure to introduce to you Dr. Tom Duening.
Thanks, Sheena. Hi, everybody. Today we're going to be talking about capital sources for new ventures. This is probably the #1 concern for almost every entrepreneur that I meet, and every student that I teach in my classes, the first question they want to ask me is, where do we get the money to start our first business? And so there's a lot of different sources of capital, and there's a lot of danger with some of the sources, so we're going to talk about that and really kind of try to figure out what's best for you. When we really think about sources of capital, it comes down to just a few fundamental principles. There are basically 3 separate sources of capital that we're going to be talking about tonight. But before we get to that, I want to talk about the role of capital in new ventures. And a lot of times entrepreneurs think about the phenomenon of being undercapitalized or not having enough money. But you can also be overcapitalized. So everybody knows about the problem of undercapitalization. That just simply means that we don't have enough money to get through the next payroll period or whatever it might be to pay the bills, to keep the lights on and keep on serving customers. But that's not always the problem that entrepreneurs face. Sometimes they actually have too much capital. And too much capital simply means that I'm not spending enough time paying attention to the details of my business to build in the kinds of discipline that I need to be effective. So be very careful when you think about the money that you need to be successful, that you are being very careful to estimate the right amount and be aware of the dangers of overcapitalization. Undercapitalization, without a doubt, is the most common problem. And every one of us faces that every time we try to push a new venture into the marketplace. We're wondering whether or not we can generate enough capital to make things happen. And in the early days of a venture, unfortunately, the sources of capital are very few. To get an idea of what you need to raise capital, however, there's really 4 fundamental tools that you simply must have. It's just impossible to raise capital without these 4 tools. And one of them is your business plan. So I don't typically recommend a business plan to entrepreneurs because a lot of entrepreneurs that I know have been exceedingly successful with or without a business plan. And a business plan has very marginal utility as you go into the marketplace and try to figure things out. If you write a plan and you are not adaptable to the changes in the marketplace that weren't reflected in the plan, you're probably not going to make it as a business anyway. You have to be adaptable. And a business plan, you have to realize, is sort of a working document rather than a finished document. But you're going to need a business plan to raise money. So that's #1. Second is an executive summary. And of course your business plan has an executive summary in like the first couple of pages But I also like to have an executive summary as a standalone document. So a lot of people that might be interested in investing in your deal don't want to read your whole business plan. They want to read just something very, very simple, very straightforward that gives them a real good idea of what you're doing. So I like to use a standard template for an executive summary that really just highlights the value proposition of the business as the #1 paragraph. And that's basically the problem that you're solving. And then a little bit of information about the financial projections of the business is going to be enough for your executive summary. Typically, you might also want to say something about the amount of capital that you're actually seeking to raise in the current fundraising round. Another thing that you're going to need is what we call a private placement memorandum, or PPM. This is a very technical document, and typically a law firm that you're working with will have boilerplate. And a lot of a PPM is what we call boilerplate, and that means it's the same across every business regardless. And a PPM is different than a business plan in the sense that a business plan is sort of the document that is not governed by the Securities and Exchange Commission of the United States. A business plan, you can say anything you want about the future prospects of your business. You can be very positive, very optimistic, very aggressive. A PPM is a document that basically has to outline all of the risks that are associated in investing in your business. And it's sort of the anti-business plan, if you will. If you want to go online and look for a private placement memorandum, there are some templates out there that you can get, that you can kind of look at to get a sense of what actually is included in this document. And this is a document, if you're going to be raising equity capital, that'll be very clear about the terms of the deal that you're looking for, the amount of capital that you're trying to raise, the amount of equity that you're going to give away in return for that capital. All will be spelled out in the PPM. And then a document that is not often recommended, but that I constantly recommend in my teaching of entrepreneurship and that I've used extensively in my own fundraising, is what I call a subscription agreement. Now, that's not my term. That's a term of the industry. But what it means is that somebody will sign a document that basically says, yeah, I'd like to invest in this deal, and here's how much I'll invest. What's interesting about a subscription agreement is that it is not legally binding in general. A subscription agreement, rather, is psychologically binding. So I always like to bring one along. Anytime I'm going to go raise money from somebody, I like to have an agreement that basically I want them to sign. If they're not going to give me a check today, at least sign my subscription agreement indicating that you're going to give me a check at some future date. I really hate to walk out of a meeting with a potential investor with them saying, yes, I like you, without some type of a psychological commitment on their part to follow through. One of the things that's interesting about raising money is that it does create sort of this tension between the person that's raising the funds and the person that is being solicited for capital. And that tension oftentimes is eased by the parties being nice to one another. And it's easy for somebody to sit across the table, you're raising money from them, and to say, boy, I really like your deal. Yeah, I'm very interested. Sure, I'll really consider giving you money, and just give me another week. And then you never hear from them again. Believe me, I've done it a million times, and it can happen with your best friends. They don't want to upset you. There's tension in the room because you're trying to raise money, which puts them in an awkward situation. They don't want to say no to you, so it's just easier to avoid you. So one of the things I like to do is make sure I get some type of a written commitment by having them sign a subscription agreement. Generally, I will inform them that this is not legally binding, but it gives me some indication of how much money you're going to be able to invest in this deal. And that usually eases the pain, but at the same time, they are now psychologically bound to you because they have signed a document. And believe me, this is used in all types of negotiations. If you've ever bought a new car, for example, and the salesman is writing out a bunch of numbers on a scrap piece of paper, and then they say, well, okay, now we're going to go see whether the sales manager will agree to these terms. Could you sign at the bottom of this paper to indicate to the sales manager that you're serious, that if he agrees to these terms, you'll buy it? And you often hesitate, because you think, gee, if I sign my name, maybe that's maybe that's legally binding. No, it's not. It's psychologically binding. And if you've ever done that, you know what I'm talking about. So this slide really shows the different stages of funding that occur in a new venture. And so as you see way down there to the left, you have the concept stage of a business. And at the concept stage, nobody's going to fund anything, right? I mean, maybe your best grandfather or Uncle Jim or something like that might give you a little money or something like that. But in general, that's your own money now that is sort of supporting you while you're conceiving your business. And even through the seed stage of the company, where it is now something that you're beginning to put the pieces together to actually get to the startup phase of your business. And it's the startup phase, it's really almost impossible to raise any kind of serious capital. It says in this document that this is where a venture needs to be before raising capital. You definitely need to be at startup. You need to be done with your product, beyond the prototype stage. And even better if you're already seeing revenue from sales of your products and services into the marketplace, even better. But in general, what we say at the startup phase of a business, the only funding that you're able to receive is from what we call F, F, and F. That's friends, family, and fools will invest in your deal at startup. And that means your money, your friends' money, your partner's money, your family's money, and anybody else that you can convince to take a flyer with you at the startup stage, because you really don't know where the venture is going to go. Then if you get, some revenue, you get some sales, we call it traction in the marketplace, suddenly a lot of different options become available to you. And we're going to talk today about those options. Those options include things like bank financing, and there's different ways to get bank financing, and we'll talk about that, and there's some advantages that you can get if you're a minority or a female in terms of SBA loans and things like that. Angel capital. Angel capital is typically defined as money that would be invested by high net worth individuals where they really want to just put their money to work. They're not that interested in being a part of your venture in terms of managing it, but they want their money to, kind of grow for them, and they like what you're doing, and they're going to put some money in it. They're risk averse. They're not interested in taking, they know that investing in a young company is risky, but they really want to make sure that they've looked at as many details as they possibly can to make sure that you are going to be successful, but they don't want to manage. That's in part why we call them angels, because they want to give you money, but they don't want to mess around in your leadership or management. And then, of course, the famous venture capital comes in if you really begin to hit the, the accelerator and get some fast growth going on, and you need abundant capital for even more growth. Venture capital is extremely hard to get. Typically, only very, very high growth ventures with incredible market potential would have an opportunity for venture capital. And these are typically firms that have a very disruptive market impact, where they're changing the way a market behaves, or they have a solution that is demanded far and wide around the world. Venture capitalists will come in, and oftentimes they will take control of the company, and the entrepreneur will then kind of step to the rear and let the professionals build the company, and then enjoy the IPO or sale of the company at some future date. So there's all kinds of, so you can see there's first stage, second stage financing, bridge financing, and these all have different venture capital type firms that would participate. So there are some firms that would be interested in first stage financing. There are some firms that would be more interested as you grow and want to put more money into a deal. And then there's firms out there that we call bridge financing companies that would take you, let's say you need a little bit more money before an acquisition occurs or before an IPO. And so you have to be careful when you're raising capital to make sure that your targets are aligned with the strategy and products and services of your company. So you're not going to go to a software company, let's say, for first stage capital if you have a medical device, right? So you're not going to go to a venture capital firm that typically invests in software if you're building a medical device. You look for a medical device first stage investing venture capital firm, and that would be most likely to deliver some capital into your venture. if they have an alignment, sort of in alignment not only with their knowledge but also with the other deals that they've already invested in. So equity financing basically is money that you would raise from individuals or institutions. And individuals, generally we call them friends and family or angels, and institutions would refer to the venture capital firms. And these are companies, when somebody invests when somebody invests equity financing in your deal, that means you are trading ownership for that capital. So if you have a company that you think is worth $1 million, right, and you go into the market to try to raise some money, and you're trying to raise another $1 million, and an angel steps up and says, sure, I'll put $1 million into your company. Well, guess what? Your company, after that additional $1 million comes in, is now worth $2 million. Why? Well, it was worth $1 million before you raised the money. Now $1 million comes in. So at the moment of the transaction, it's worth $2 million. Well, if I put $1 million into it and it's worth $2 million, guess how much I own? 50%. So you owned 100% up until that transaction, and suddenly your ownership percentage has been cut in half. And that's the way it works. So when you're going to raise money, you want to make sure that you raise just enough that you're not getting what we call diluted to the point where you lose control of your enterprise, right? So if I'm only worth $1 million, I don't want to raise $1 million. I might want to raise maybe $250,000. Now I'm only going to give away 20% of my company. And then I use that $250,000 to build a lot more value. So I try to convert my company now from a $1 million value company into a $5 million value company. Now if I raise $1 million, I'm only going to be diluted 1/6. I hope you're following this. If I had a whiteboard, I'd be writing all over it. But so you can understand that you have to kind of stage your capital investing if you're going to be taking some equity financing, so that you don't give away too much ownership of your company. Again, here we talk about the private placement memorandum. And you need to know, anytime you raise capital in this country, equity financing in particular, it is governed by the Securities and Exchange Commission. Even though you're not listed on the public exchanges or anything like that, even private exchanges of equity in this country are governed by the Securities and Exchange Commission. So there's very, very strict rules that you need to follow with respect to your fundraising. So if you're going to go out and do equity financing on your company, even if it's from friends and family, you are well advised to have an attorney on board who can help you manage that transaction and have all the appropriate documents in place so that you don't run afoul of the SEC. You simply don't want to do that. Now, there's no police out there that are going to be looking for it, but if your company really grows and begins to scale and you have a great opportunity to exit, something that you misstepped early on because you were kind of cutting corners could come back and bite you, and you just don't want that to happen. Angel investors, as we said, are high net worth individuals. They're interested in investing in generally high risk and high return private ventures. They don't want to be, sometimes they'll be on the board, but they don't want to be involved in day-to-day management. And so they're a source of capital for seed stage and early stage firms. So if you're going to get some angel investors, it's really good to look for those that were going to add some strategic value to the company in addition to capital. That means that they would have some expertise that would be relevant to your business in terms of your market that you're going to be pursuing, or the products and services that you're developing. Perhaps they've been in the industry before and they can open some doors for you and get some clients and things like that. Because they have a financial interest now, they're going to be motivated to help you open some of those doors. So I always look for angel investors that not only have capital, but have some strategic value to the company as well. Whether or not I put them on the advisory board or whatever, doesn't matter. I'm going to consult them and ask them to open some doors, and the reason I can is because they have a financial interest in the future of the company. There's this exercise called due diligence, and any angel investor that's really worth their salt is going to perform due diligence on your venture. That means they're going to really look at the deal and maybe have their accountant look at your books and so on to make sure everything is clean. They don't want to absorb any kind of liability by virtue of taking an ownership stake in a company that is under some kind of a legal proceeding. So they're generally going to be careful, and And my best advice to you is advice I got from a good friend who's a very, very good entrepreneur. And he said, look, the best way to make sure that you're always going to be eligible for capital is to run your company from day one as if you're going to sell it tomorrow. And that makes a lot of sense. That means always be clean, always make sure you're getting audited at the appropriate intervals and so on, and keep your books nice and clean. When you need money and you want to go raise money, the cleaner you are, the quicker you're going to get the capital that you need. Venture capital, as we mentioned. Oh, let me say one more thing about angel investors. So angel investors exist in basically, I'm going to just say two varieties. One is independent kind of investors out there, and you can maybe find them at the country club, you know, at places where wealthy people hang out, and that does happen. And I have never really been too successful with that, and the way you learn about them is through networking. But there are also angel investing groups, and these are aggregations of angels where they come together to meet maybe monthly or every other month or whatever, and actually have entrepreneurs come in and present to them. And then they kind of have this herd mentality, and if you can win one or two of them over, even before you go into the meeting to actually present, it can be a huge thing for you. I had an angel investing group in Arizona called the Arizona Technology Investor Forum, and we were able to do some major investing with companies that we really liked because of this herd mentality. So in one instance, I remember a deal came in. It was a software play. And the angels, we had about 50 angels in our group. We really liked the deal. We invested $600,000 in that deal before 24 hours was over. We just really moved quickly. Didn't even do all this due diligence because we just wanted to get involved in the deal. So look for those angel investing groups. They're all over the country. They probably are centered in what's called the Angel Capital Association, ACA. If you look that up, you can probably, they probably have a map there that would indicate in your state, wherever you are, where the angel groups might be and how it is that you might be able to get in front of them. Venture capital, again, this is kind of located mostly on the coasts, you know, the East and West Coast, and you know that Silicon Valley's got a lot of venture capital firms, Boston, New York, and so on. And they really do sort of specialize. So you really want to find a venture capital firm that is consistent with the type of venture that you're trying to build. And as I mentioned before, in terms of medical devices or software or whatever it might be, you want a firm that generally has an investment portfolio that's already already contains those kinds of deals in it. So the way to find that out is to just visit their website. Typically, a venture capital firm will have what's a tab on the home page of their website. It'll say portfolio companies, and the portfolio companies are those companies that they've invested in. And so you can look at them to see whether or not there's a match with what you are. And besides getting sort of a match with the portfolio, you want to get a match with the stage of financing that they do. So if they only do, you know, second or third round or third stage financing, and you're a seed stage or early stage company, they're not going to invest in you, and you're going to waste your time. Venture capital is tough to get, but you know, I know a lot of folks who have gotten it. I've gotten a little bit in my career, but I know I've had knock on a lot of doors, and there's a lot of rejection along the way. You got to be determined, and you got to be resolved. So we talked a little bit about the costs of equity financing, and this is really has to do with the dilution of your ownership. And you know, so you think, well, why would I want to dilute ownership? And the cool thing about equity financing is that you don't have to pay it back, right? So if the venture is going south and it's not working, not like a bank, right? The bank can still have a claim on the assets of the company. Equity investors do not. When they sign a PPM and say, I'm going to go ahead and they sign a shareholder agreement to invest, they know that there's a substantial risk of loss of all of their capital. And the other thing about equity financing is it doesn't accrue interest payments. So you don't need to make interest payments while you are using that capital as you would with a loan from a bank, for example, right? A couple other terms that we've talked about already. The pre-money valuation, that's the valuation of your company before any outside equity capital comes in. And the post-money valuation is just the value of the company where you add up the pre-money with the amount of money that came in. So let's say I say my pre-money valuation of my company is $1 million, okay? My company is worth $1 million. And there's a lot of reasons for that. I'm not going to go into that tonight. That's a separate discussion. And let's say I raise $500,000. So that means that with the pre-money of $1 million and the money coming in of $500,000, the post-money value of the company then is $1.5 million, $1,500,000. And the investor that put in the $500,000 now has 33% ownership. And I have been diluted by 33%. Debt financing can come from many different places. You know, we talked about friends and family, so you can get equity capital from friends and family, but I know a lot of people that start ventures that have taken loans from friends and family. I've never done that personally, but when I've seen it happen successfully, generally it is handled in the same way that you'd handle an institutional loan. There is paperwork that identifies the amount of the loan, there is paperwork that identifies the term of the loan, and there's paperwork that identifies the interest rate that will be paid on that note. And so if you're going to borrow money from friends, family, or even internally within the business, make sure that it's well documented and that everybody is satisfied that they know the terms and what the recourse will be if the terms are not met. I've seen a lot of partnerships and a lot of families in distress because they haven't spelled out the terms appropriately and people are expecting to be paid, they're not being paid, they don't know what their recourse might be, and the only recourse that they have is to get angry. Institutional lenders, of course, are banks. Institutional lenders are going to require collateral, which of course means that they can secure the collateral for themselves in the event of a inability to pay on a note, a default on a note, and you know, when it comes down to your business, we have this wonderful thing in this country that is, you know, called the limited liability. And that means you can limit the exposure of your personal assets to seizure by a bank or institutional lender in the case that the business has to default. Unfortunately, for an early stage company, a young company, oftentimes the individual entrepreneur has to pledge their personal assets in addition to the business assets in order to get a loan at all. And so even though we have limited liability and we have protection of the corporate veil, a lot of times if you want to get some type of a loan from a bank in your early stage and you have no operating history, the only way to get it would be to pledge your personal assets. In that case, if the business does default, the bank or institutional lender can actually come in and seize your personal assets. So be aware of that, and that's going to be the case for almost any kind of a loan, even a long-term lease, for example. Oftentimes for an entrepreneur, when they get a long-term lease in a corporate office building, typically 3-year lease, and they simply have no operating history to speak of, oftentimes the individual CEO, entrepreneur, is going to have to provide a personal guarantee on that lease. So the loan rates that you're going to be exposed to as a startup company are going to be much different than that of an established company. So you know, the prime rate is the rate that banks will charge to great big institutions, corporations that they are very, very confident they're going to be able to pay back the note and the interest. And you're going to pay something prime plus, which is going to be a factor quite a bit higher than the prime rate. In general, you know, going rate today is going to be anywhere from 9 to 12% on a note, especially a short-term note. Long-term note, maybe a little bit higher. So you're going to have to shop around a little bit to see which bank is going to do the best work for you. Again, same thing as a venture capital firm. Institutional lenders are oftentimes going to have specialties. So some institutional lenders are going to be very good at understanding how to loan to construction, right? They're home builders. Others will be more inclined to loan towards other types of ventures, maybe restaurant ventures. So shop around to find a bank that seems to match what it is that you're doing, that understands what you're doing. Develop a relationship with a banker long before you actually need them. I find that bankers are ready, willing, and able to step up and lend you money when you don't need it, but not as willing to lend you money when you do need it. So you might as well develop that relationship. begin to develop an operating history, maybe even take out a little bit of a line of credit that you would use to begin to establish a credit history with the bank. The term of the loan is just a length of time for payback, and you've probably heard of a mortgage, and a mortgage is typically 30 years. So it's a long-term note, and interest rates are, right now in the 3-4% range. Short-term notes are going to be of a year or less. So depending on, that's a technical term that would be used on a balance sheet. A short-term loan is less than 1 year. Long-term loan is typically anything longer than a year. All loans are going to have what they're called restrictive covenants, and these are kind of dangerous, and you have to be very careful. Most of us, when we sign these contracts to buy a car, get a lease or something, we don't want to read all those terms. But a bank note is different because there are positive and negative covenants. And positive covenants will tell you what kind of performance targets you need to maintain in order to stay in good standing on the note. And negative covenants are things that if you fall below these performance standards, they're going to possibly call the note. So what happens when a bank believes that somehow or other you're running afoul of your business practices and you are no longer maintaining the covenants, there will be a clause typically in that loan agreement that says they can call the entire note immediately. So if you are sitting there and you're using that loan to build your company and all the money is tied up in working capital, and the bank says, well, you're not meeting, the covenants that we've established here, and so we're going to call the note. The only way to pay it is to sell everything, that is maybe your inventory, whatever that's involved in working capital, equipment, whatever it might be, and that's not a good thing. So you need a banker that's going to be able to understand your business and the kinds of cash flow cycles that your business is going to experience in order to be able to have the right type of note for you. Line of credit is always good to have. A line of credit simply means that you're able to use capital from the bank without having to go through the process of always applying for a new loan. And typically the bank will set aside a certain amount that you can use on a monthly rolling basis, and they're going to charge you for that, of course. Every time you take out some of that money, interest will accrue, and of course they expect that to be paid back. They will also probably charge a maintenance fee just for holding that capital, even though it doesn't really exist in a vault or anything somewhere, but just for the sake of them making it available to you without having to go through signing a whole bunch of new loan application papers, they will charge you a maintenance fee. It's not that bad, but it's just more expense for your young company, and you need to be aware of that. But it's nice to have. If you have any kind of issues with respect to the cash flow cycle, and most young companies do. I know, years ago when I was starting my company in India, I had some great big clients, and they just kind of decided that they would pay their bills whenever they darn well felt like it. And some of them took as much as 60 to 90 days to pay the bills. Well, I simply couldn't wait for that. And it was killing me until I realized that if I set up a line of credit, I could probably get through some of those times. We've gotten past that now with our big clients, and there's a lot of ways to do that. And I guess I should mention that one of the important things that you need to do when you're working with big clients to manage your cash flow cycle is make sure that you are sending invoices immediately upon the completion of whatever work or delivery of a product. And make sure that every invoice that you send has got a clear invoice number on it and a date and contact information so that you can date when that invoice actually got into their accounts payable system. Further, and a very important thing that I learned along the way with the big clients I worked with, I still work with in my outsourcing company, is you want to get on what's called the preferred vendor list. And so when you are working with your client, make sure that you ask them, hey, do you have a preferred vendor list, and how do I get on it? The quicker you get on that, the more timely your payments will be, and the easier cash flow cycle is going to be able to manage. Now my clients pay me within 15 to 30 days, and I mentioned before that it used to be like 90 days. Another opportunity for young entrepreneurs, in a lot of different industries is what we call SBA loans, Small Business Administration loans. And what's important to recognize here is that these are loans that are guaranteed by the federal government, not actually originated by the federal government. The banks will actually originate the loans. In other words, they will be the ones that will fill out the paperwork and actually write the check to you. But the reason that they'll do that is because the federal government will guarantee up to 85% of that loan in the case of your default. And there's a lot of different types of programs, and I suggest that you go to the Small Business Administration and kind of get a sense of what those programs are. Probably the best place to go if you want to get the paperwork for a Small Business Administration loan is your local Small Business Development Center office. They're all over the United States. They're called SBDCs, or Small Business Development Centers, and they really do specialize in helping young companies get SBA loans. They know who the bankers are. They know what programs are being favored by the federal government. So sometimes, like right now, it's export companies. If you have an export company, there's a very strong chance that you're going to be able to be eligible for an SBA loan. If you are a minority, female, that fits in some of these specialized industries, even higher chance. So take advantage of that, because it can be a way to get access to capital that you wouldn't have otherwise. Veterans, in particular, would have a great opportunity for SBA loans. The only thing you need to know about SBA loans is that they do have usually fairly heavy paperwork and covenants associated with them. The federal government obviously wants to keep a close track on your use of the money that they're guaranteeing, and so a lot of people say they don't like SBA loans because of the heavy paperwork involved and the reporting that's required. But at the same time, if there's no other source of capital available to you, this can be a pretty good source. Another source that a lot of people don't know about is the Small Business Innovation Research Program, or SBIR program. This is also administered by the Small Business Administration of the United States, Office of Technology. And if you have never looked into SBIR, I recommend that you do so immediately. If you are building some type of technology or some type of a service in a favored industry by the United States government, there are some pretty substantial grants that are available via the SBIR program. A lot of different government agencies will provide capital to young companies that are innovating in these favored industry categories. And today it's clean tech, green tech, alternative energy, wind power, batteries, and so on that are favored. And there's programs available if you're building a company in these areas. Now, typically, a phase 1 award would be up to $150,000, right? So you get $150,000, and this is no strings attached money. So that means it doesn't eat up any equity in your company, and it doesn't require that you pay interest and pay it back. So I really like grant programs in the sense that they're very favorable to the entrepreneur. It doesn't mean that you don't have these burdens of having other people's money that you need to manage well. But at the same time, you have to be in compliance with the restrictions that the government is going to place on how you use that money. Now, if you get to phase 2 and phase 3, even larger amounts of capital are available, up to $750,000 in the phase 2 program for SBIR awards. There's another type of technology transfer program called the STTR. It's a little bit more limited in scope. You can read some of the eligibility criteria there and see whether or not some of these programs might work for you. So again, I would go to Google, type in SBIR, type in STTR, and you'll be directed to those places, federal government websites, where they describe these programs in more detail. Finally, the type of financing that I'm most familiar with and that I think every entrepreneur has used is what we call bootstrap financing. And bootstrap financing simply means, look, I'm only going to operate according to the amount of money that I'm able to generate through my own operations. And that means the revenue that I get from sales, I'm going to put it right back into the business. All the net profit is going to get put right back into the business. I'm going to try to grow this business year by year, day by day, only using the capital that's flowing through the system based upon our own sales. And depending upon the ramp rate, how quickly you're growing, it's possible that you can survive and do well this way. But at the same time, it's tough. Typically, that means you're going to have to dig into your own pocket. You might have to mortgage your home. You might have to use your credit cards in order to get from point A to point B. And I typically talk about building a venture as pushing a rock up a hill. You can imagine some guy standing behind his great big boulder pushing it up the hill, And there's actually a top to that hill, but the boulder keeps slipping back down. And finally, eventually if the entrepreneur pushes hard enough and has enough energy in the form of capital, that rock gets to the top and begins to roll down the other side. And of course now, you've preserved 100% of your ownership because you haven't taken any equity capital, and you don't have any debt because you haven't taken any loans. You've certainly put a lot of sweat equity into the deal, but guess what? The boulder's rolling down the other side of the hill, and you're cash flow positive. Boy, there's no better feeling in the world. What I've done here is organized a bunch of resources for you to go ahead and take a look. There's the angelcapitalassociation.org. That has a lot of information about where angel investors are aggregating themselves. I have linked to the Arizona Technology Investor Forum, atif.az.org. I formed that group in 2006. It is still operating, and you can certainly apply to that for financing. This is the National Venture Capital Association here, NVCA. The SEC. Redherring.com is kind of interesting because it talks about where the money is flowing and who's putting money into deals. TechCrunch is the same. Wired VC is a Wired magazine, part of their overall online environment where they talk about venture capital. And then this Own Your Own Venture has a lot of resources for those who are interested in raising capital. So that's the end of my presentation. I'm going to turn this back to Sheena. If anybody has any questions, please don't hesitate to send those in to thestartuppath.com, and we'll be happy to respond. So thank you very much for your patience and participation tonight, and we certainly look forward to seeing more of you at thestartuppath.com.
Thank you, Dr. Duening. It was great to learn those details about accessing capital. I never knew how few options startup ventures really had other than friends and family. But it's nice to know there are more and more options as you grow. Now, Dr. Duening provided us with a lot of information in this short webinar. However, there are many additional details to accessing capital that he didn't have the time to cover. Fortunately, we have a full lesson on accessing capital available to you in Step 4 of the Startup Path. The lesson is titled Raising Capital. I urge you to register for Step 4 and learn more about raising capital. Step 4 also includes invaluable templates that will help you develop your financial forecast and write your own business plan. Dr. Duening walks you through each step and provides insights into the realities of starting a business. In fact, for joining this webinar today, the Startup Path is offering a 25% discount to Step 4 or any other item you wish to purchase at the Path. Write down this coupon code. Use it when you check out and get started today. This discount is being offered only to the first 100 people who decide to take that first step. Of course, the Startup Path offers a 100% money-back guarantee if you are not satisfied with your purchase. We look forward to helping you reach your dreams through your own business. Please stay in touch and let us know how well you are doing. We are here to help. Thank you for joining us and have a great evening.